Welcome back to the Deep Dive. Today we are jumping straight into Donaldson Company, or DCI, and their really impressive Q1 fiscal 26 earnings.
Yeah, and for anyone not familiar, DCI makes these incredibly advanced filtration systems. Think of them as, the high-tech lungs for everything from giant construction engines to hyper-clean data centers.
And their Q1 report was, well, it was a bit of a shockwave, wasn't it? This wasn't just a small earnings beat.
Not at all. It felt like a fundamental shift. They hit record operating margins, they raised their profit guidance pretty aggressively, and the stock just exploded, all during an intraday session, too.
So our mission today is to unpack that. How did a filtration company suddenly become this market darling? We need to dig into what's driving this margin story and, what it means for the company's valuation going forward.
It's all about separating them from the rest of the industrial pack. And the best place to start is with the hard numbers, because they really set a constructive tone.
Okay, so let's start with the bottom line. Earnings per share.
Right. They reported an adjusted EPS of 94 cents. And the consensus on the street was, maybe 92, 93 cents? So a clear beat.
And that's 13.3% growth year over year. That's very strong.
It is. And then you look at revenue, it came in at $935.4 million.
Which beat by about 12 million or so. So not a massive beat on the top line, maybe 1.3%.
Exactly. The revenue beat wasn't astronomical, but in this kind of sluggish industrial environment, any growth is good. And getting almost 4% year over year growth.
And then leveraging that into a big earnings beat. That's the formula that gets investors excited.
And they got very excited. The market validation was immediate. The stock closed up nearly 7.5%.
On huge volume, too, 1.6 times the average. It hit a new 52-week high.
And that kind of forceful move, it tells you the market is seeing something more than just a good quarter. They're seeing a structural change, a real improvement in the business itself.
Okay, so let's get into that, the margin story. Because this seems to be the absolute core of the bull case for DCI.
It is. This is where it gets really interesting. DCI delivered a record Q1 adjusted operating margin of 15.5%.
15.5.
Yeah.
And that's up 60 basis points from last year.
A huge improvement for a company of this scale. And here's the fascinating part. They did this even though their gross margin actually slipped a little bit, down 20 basis points.
Wait, hold on. So the cost to make their products went up slightly, but their overall profitability hit a record. How does that work? That seems contradictory.
That is the entire story. It's the perfect question. The magic wasn't in the cost of goods sold. It was in their operating expenses.
So things like R&D, sales, general admin costs.
Exactly. As a percentage of sales, their operating expenses dropped by 80 basis points. Management said it was a mix of sales leverage, so squeezing more profit from each sale, and these really significant cost optimization programs they've been running.
So they're just getting leaner and more efficient. It's a self-help story, not just riding an economic wave.
And you see it in the cash generation. It was exceptional. Operating cash flow more than doubled year over year.
Which gave them a cash conversion rate of 101%. They're turning every single dollar of reported profit into actual cash.
Which just speaks to the quality of the earnings. This isn't some accounting trick. It's real, tangible cash flow. That's the foundation of a quality compounder.
Okay, let's break down where the growth is actually coming from, the segment performance. Because this is where that pivot narrative really comes to life, right?
It does. You start with their core business, mobile solutions. It's the biggest at almost $600 million in revenue, and it grew 5%.
And the driver here is that razor and blade model, which we love.
It's a beautiful business model. They sell the initial equipment, the razor, and then they get this long, sticky tail of high-margin replacement filters, the blades, for years and years.
And that aftermarket business was strong. We saw their independent channel grow by almost double digits.
Yeah, that recurring revenue is so resilient. But, they're not totally immune to the macro economy. The on-road part of their business, think big trucks, was down 27%.
Wow, 27%. That's a big headwind.
It is. But that's where their diversification is so smart. Because while trucks were weak, their off-road business grew 6%. Strong demand in construction basically canceled out the weakness in agriculture.
A classic portfolio balancing act. Okay, now let's talk about the real growth engine here, life sciences.
This is the turnaround story. Sales were up 13% to $79 million, but that's not the headline. The headline is profit.
Right. The profit margin went from a loss of 7.6% last year
to a profit of 9.2% this year.
That is a 16 percentage point swing in 12 months. That's a fundamental turnaround.
It's huge, and it's being driven by their food and beverage and disk drive businesses. Both of those grew over 20%.
And this is where DCI plugs into these big secular trends. Food and beverage filtration is about bioprocessing, clean tech.
Yeah.
Disk drive is about, the advanced data storage we need for everything.
And management was keen to point out they're investing in new tech, like hammer-ready filtration for next-gen hard drives.
Yeah.
This isn't your grandfather's filter company anymore.
Okay, finally, industrial solutions. That segment was flat.
Flat sounds boring, but in this environment, flat is a win. And underneath that flat number, there's a huge pocket of strength in power generation.
And this is the AI story.
This is the AI story. Power generation is all about supporting the data center build-out. You need a massive, reliable power for AI servers, and you need DCI's filters to protect those systems.
And what was it the management said on the call that got everyone's attention?
They said their order books for power gen are full for the rest of the fiscal year. That's secured demand in an explosive market.
And you have to see how this all connects. The data center theme runs across the company, right? It's in power gen, it's in the disk drive business, in life sciences, and now they're even looking at liquid cooling for servers.
It's a strategic masterclass. They're positioning themselves as a key infrastructure provider for the entire digital and AI revolution.
This is the point where you stop thinking of them as just a component maker. Okay, let's talk about management execution and why the guidance raise was so significant.
Right, because this all comes back to things they can control. The self-help measures, they're still optimizing their global footprint, and they said the biggest benefits from that are still to come in the second half of the year.
So there are more margin tailwinds on the horizon.
Yeah.
But I have to be a little skeptical for a second. The quarter included a $9.3 million gain from selling a plant in the UK. Isn't that a one-off that makes the numbers look better than they really are?
That's a fair challenge. And yes, that gain helped Q1. But the forward-looking guidance is what matters, and that's built on sustainable improvements. For example, they managed to cut the expected negative impact from tariffs from $35 million down to $25 million.
Now that is pure structural cost control.
Exactly. And that kind of execution is what gave them the confidence to raise their full-year profit outlook so dramatically. This is the real reason the stock re-rated.
So they raised the full-year EPS guidance to a new midpoint of $4.03.
While keeping sales growth guidance the same at 1 to 5%. And importantly, the only part of the forecast they cut was for that weak on-road truck market, which is less than 3% of total sales.
But they trimmed the weakest part and raised the whole profit picture. But the most important number they raised was the operating margin target.
Yes. The new midpoint for the full year is 16.5%. That implies an expansion of 80 basis points for the full year, and it signals they believe they can achieve an incremental margin. So, profit on new sales of over 40%.
Which is just elite-level operating leverage.
And what's fascinating is the contrast between how management talked and how the market reacted. The team on the call was, constructively bullish, but they were very clear, we are not ready to call a full economic recovery.
Meanwhile, the market just went for it. Investors are basically saying, we don't need you to call it. We see the structural improvements, we see the secular growth, and we're pricing that in now.
They're rewarding the execution, not waiting for economic luck. And this is why DCI is breaking away from the rest of the industrial sector.
I mean, just look at the performance. Over the last year, DCI is up, 26%?
Roughly, yeah. Compare that to the S&P 500 at around 17% and the industrial ETF, the XLI, which is only up about 10%.
It's in a class of its own. It's completely decoupled.
And that's because the investment thesis has fundamentally shifted. It's not a late cycle industrial anymore. It's a specialist filtration compounder that's plugged into AI, data centers, bioprocessing.
Plus, you have that defensive base with the sticky aftermarket sales and their incredible capital discipline. They returned $127 million to shareholders this quarter.
And they're an S&P high-yield dividend aristocrat. This is their 70th consecutive year paying dividends. 70 years. That kind of stability is a powerful anchor in a volatile market.
All right, that brings us to our favorite segment. This is not financial advice. But if you were walking into an investment committee today, what's the outrageous but plausible trade idea based on all this?
Look, given everything we've seen, you have to argue that DCI doesn't belong in the traditional industrial bucket anymore. It's fundamentally different.
So a relative value trade. You go long DCI.
And you go short a lagging, pure play industrial stock from the XLI, something that doesn't have DCI's aftermarket moat or its exposure to life sciences and AI, a company that's still just waiting for a cyclical recovery.
The thesis being that DCI's valuation multiple is going to permanently expand. It's not going back to trading like a generic parts supplier.
Exactly. With a 16.5% margin target and a full data center order book, you're betting that DCI completely breaks away from the industrial PE range and gets re-rated as a specialized technology enabler.
So to sum it all up, DCI delivered a really powerful quarter, raised its profit guidance, and basically proved its pivot to these higher margin secular growth markets is real and it's working.
The story is no longer about riding the economic cycle. It's about compounding earnings through the cycle, thanks to that aftermarket moat and their high-tech growth engines.
Which leaves us with a final provocative thought for you to chew on. If DCI keeps executing like this, hitting these structural margin goals year after year, how much higher can its valuation actually go before analysts finally stop calling it a filter maker and start pricing it for what it's become? A technology-enabled specialist compounder. It's a question of perception catching up to reality.